Well, good morning, everybody, and welcome to Contact Energy's 2016 full-year results. I'll run through a presentation, and Graham will take over at parts. But before we get into it, just the usual disclaimer, and then the agenda for the conversation. We have a very similar agenda to the last time we would have talked, where our strategy continues to leverage our integrated customer and generation business, providing choice, certainty and control for our customers, whilst operating a long-life, flexible, low-cost generation portfolio. The performance for the period is in line with the announcements we made in December and February. Flat EBITDA year on year, but a significant improvement in cash flow. The only change since our last conversation would have been that we've taken a write-down on our gas inventory, but the Otahuhu and Tahiki write-downs were foreshadowed in February. In a bit more detail, the competition in retail has largely been offset by a continued lower cost of energy. Our retail performance has lifted throughout the year, showing itself in increased customer numbers and through what I would say are historical best operational metrics. We did have a very strong performance in our geothermal business, where despite an extended outage we achieved record production, and it was reasonably wet in the year. We declared a dividend today of 26 cents share, same as last year, partially imputed, with a smoothed increase over time to full imputation as our credit balance will allow. But we also deployed $100 million to a share buyback and reduced our debt by $71 million. We do believe we have a much more balanced energy and capacity market in New Zealand now, with some closures of power stations. I still believe that TY is important for long-term fuel and for some contracts that support TY, although we believe any TY exit risk is increasingly manageable. The debate on carbon has probably passed. Transmission pricing is ongoing, but we do believe there's an opportunity for the Commerce Commission and the Electricity Authority to work more closely together when thinking about future regulation for new technologies. And then just looking short-term forward, we do see that our continued improved performance will support strong cash flow. We will reduce costs, but at the same time our carbon costs go up. Obviously the TY contract starts in January, and that is at a lower margin than some of our older contracts. And the changes we've been making positively to our product set, we expect to give us some improved performance, but of course we will maintain our competitiveness, and therefore the results of that are not fully controllable. So what does that look like in the numbers? The numbers are dominated by the non-cash items, the write-down of Otahuhu, Tahiki and gas inventory, but I will draw you to the improved cash flow and a stable dividend. But Graham will talk to that in more detail. So what's going on in the market that contributed to the performance in the year? We had relatively flat demand, some sectoral increases in residential commercial, but with industrial coming off a bit. And obviously agriculture and irrigation does move the demand numbers around. But my continued theme of demand is, flat to modestly improving is sort of borne out in these numbers, and a big feature was a very warm second half. The retail market maintains is still very competitive. Market churn has increased, number of new entrants has increased. However, our position relative to market has improved, with customer gains and lower churn to market on average for the year. We have seen the gentailer part of the prices fall for a number of years, and perhaps a modest improvement from our perspective in March, but again, subject to the competitive market. And commercial and industrial load does what it always does, which is follow the ASX forward pricing. In retail, we evidence through a number of metrics the improving performance. These are a list of operational metrics we've produced a couple of times now, and you can see that on every measure we're improving the performance of that business. My view is that in the long term, success in retail is going to be driven by customers promoting you, and that's why we are using the globally recognised Net Promoter Score as one of our primary measures, and as we can see, that's on the up. Doesn't come without an awful lot of hard work, as this slide evidences, a combination of capability, systems and process changes, and more to come. And we're seeing the CLV, or customer lifetime value, of our customers improve. That is, customers who are staying for longer, paying, using more, and having a cost to serve characteristic that suits their product. We've said before that some customers do not give us any greater return than a wholesale sale, but we can see that we're moving that position to the right. At the same time as giving customers more choice, certainty and control, which is going to take a lift in August as we introduce a whole heap of new product constructs, where we move away from the very simplistic discount level conversation to one which is about which properties you bring, which fuels you bring, what price point you want, what flexibility you want regarding contract duration. So a whole pick and mix of opportunities for the customer to pick a product that suits them. And from our perspective, a product set which is easily changeable based on what the market's telling us at any point in time. I was going to go to questions at the end, Jenna. The wholesale market remains rational. It has been wet for a few years, but we have seen with the recent capacity retirements the hydro risk curves change, which is what is the risk in a dry sequence. Obviously, a big feature of the market is the potential for the TY smelter to exit. They had an option to reduce their demand last month when that passed without being called. Clearly, we have a contract to support the smelter, which starts in January. And we continue to manage our cost base in the event that the smelter does exit through managing maintenance timing on our large gas-fired plant, limiting how much gas we buy, and being ready to upgrade the part of the grid around our assets in the lower South Island. In the event of a closure, I think the industry response would be swift. Fuel would stop being purchased. The way the lakes and flows across the DC would change. We believe there's some low capital or no capital opportunities to improve the flow of the HVDC. So we do see that the TY staying or going risk is increasingly manageable. On our generation business, our operations, the 7-odd terawatt hours of renewable generation we produce, we're becoming increasingly efficient. 70 gigawatt hour improvement on geothermal with minimal capital investment. A year where we had extended outages in our geothermal business, we still delivered record production. We are continuing to improve the cash performance of that business, and that's resulted in us bringing forward the decommissioning of a few wells. Some of these wells are 50 years old and are costing more to keep going than we return from them, but it does accelerate depreciation a little bit. We still look for opportunities to develop Tauhara, including direct heat. And our hydro production in a mean year is now probably more like 3,900 gigawatt hours than 3,700 gigawatt hours. So minor changes to increase the renewable production for New Zealand and obviously helps our performance. All of that rational behaviour is supported by what I would say is a reasonably good regulatory regime, but occasionally there are areas where we do comment. One is around emerging technologies. Current regulations are designed for a structure which is changing to one where customers are going to have more control of energy production and use, and we think that the Commerce Commission and the Electricity Authority should be more coordinated on that. Transmission pricing is ongoing. We support the process. We would like it to conclude this year as planned, but it is something which is the devil's in the detail, and that's what we'll watch. The boat's probably sailed on carbon. Carbon costs will increase for our business. We don't believe it changes behaviour in stationary energy, and you can see from our carbon performance over the last few years, we're certainly doing our bit. Our annual report was released today online with a theme of sweating the small things, and that's what we are focusing on to improve our performance on safety, our staff engagement, our customer promotion, and also our cost structure. And for that, we need all of our staff to be engaged in our priorities, and we have seen some improvement in that this year, but it's absolutely a focus for our business going forward. So with that quick rundown, headline numbers, what we believe is going on in our business and the market, Graham will tell you what actually happened in the year, and then we'll come back to a quick wrap-up and questions. So, great.
Thanks very much, Dennis. So if we turn to page 17 of the slides, we have a few of the highlights for the period and numbers. As you've already seen, the EBITDA underlying profit figures are largely in line with last year, but free cash flow is up considerably. While discounting is impacting our retail netback, our work on improving our cost of energy continues to produce good results. Slide 18 reconciles the statutory and underlying profit measures from FY15 to FY16. You can see that underlying profit is down by $4 million as a result of our lower EBITDA and higher financing costs following the special dividend in June 2015. Depreciation and amortisation were $3 million less than last year, and we now expect FY17 D&A to come in between $205 and $210 million. The increase over FY16 is due to the decision to close some geothermal wells rather than continue with their maintenance costs. Statutory profit was significantly impacted by the impairment relating to Tahiki, the closure of Otahu, and the write-down of inventory gas, which we cover in more detail on the following page. So we reported on the Otahu closure and the Tahiki impact at the half year, so we won't go over that again. But the news from the second half is the write-down of inventory gas. Accounting rules require us to carry inventory gas at the lower of cost or net realisable value. Based on what we expect to receive for using this gas in electricity production, we concluded that the net realisable value was less than the carrying value and wrote it down by $43 million. The new value is more in line with current gas prices and will likely see us making increasing use of stored gas rather than buying spot or short-term contract gas. This item is clearly non-cash and has been excluded from underlying profit. If we turn now to the segments, page 20 breaks out the EBITDA movement into the two segments and shows the principal drivers of the overall movement. The other segment was flat year on year as LPG growth offset our shrinking electricity meters activity. For integrated energy, the overall segment is down by $2 million to $484 million. While in aggregate it clearly looks flat, clearly there is a fair amount of movement in the components. As you can see, retail netback is $59 million less than last year, while cost of energy is improved by $57 million. We'll go into more detail on these figures in the next couple of slides. So slide 21 is the detail on netback. Clearly there are a lot of figures on the slide, but essentially there are two main causes of the lower retail netback. First, a 9% drop in C&I volumes, which was the result of some large C&I customers rolling off at the end of FY15. While the volume impact looks quite large because there were relatively low margin sales, the overall EBITDA impact is not that great. We see the corresponding benefit in a lower cost of energy. Second, the continuing discount in the mass market has led to a $5 per megawatt hour year-on-year reduction in the mass market netback. This is of much greater concern to us, with around half of our sales going to the mass market. The second half has seen some slowing in the rate of discounting, but it remains an issue. Slide 22 then covers on the cost of energy, and it highlights our continuing improvement in our cost of energy, where we've reduced the total cost by $57 million. As I mentioned, some of the improvement was due to the lower purchase volumes arising from the lower C&I sales, but we also saw a higher level of geothermal generation, which meant we needed less thermal generation and therefore purchased less gas. The closure of Otahu also reduced our gas transmission and ongoing operating costs. If you turn to slide 23, we've added a slide to the usual pack to give you some history and trends on margins. The chart shows the relative contribution of our three main businesses to the overall EBITDA figure. We've used an arm's length price between generation and retail for each share based on ASX. And as you can see, the investment in generation has led to a substantial reduction in gas requirements over the period, reducing our cost of energy and increasing the EBITDA contribution of generation. In parallel, our retail netback has declined by $12 per megawatt hour over the last 4 years, leading to a reduced contribution to EBITDA from retail. Slide 24 is addressing our OPEX and CAPEX. And you can see there we've made good progress on reducing our other operating expenses, which in FY16 was $16 million lower than they were in FY15. Operating costs will continue to be a key area of focus for us in FY17, particularly as we can complete our system separation from Origin and increasingly make digital self-service a key part of our customer experience. On CAPEX, the outturn for FY16 was up from FY15, largely due to the recognition of the Stratford Peakers spare supercore and the initial payments for the TCC refurbishment. And the guidance for CAPEX is largely in line with what we provided at the half year, but we've added 2 further years to the outlook, and what you can see in those out years is that we are not expecting to drill any new geothermal wells until after FY20. Slide 25 covers free cash flow, and we use free cash flow as a key metric as it clearly shows how much cash we have available to fund growth CAPEX, dividends, and pay down debt. Free cash flow in FY16 was $58 million, or 17% higher than FY15. Operating cash flow was $66 million higher, largely as a result of lower tax paid following the closure of Otahu. And the proceeds received during the year from the sale of Otahu were effectively offset by the payment for long lead items relating to the refurbishment of TCC. So where did we apply that free cash flow? Firstly, the board has decided to pay a final cash dividend for FY16 of 15 cents. And as we've said in the last 2 results announcements, the payments of the fully imputed special dividend in June 2015, along with the sale of Origin's controlling position in August, essentially eliminated the imputation credits we had at the time. So since then, we have accumulated some imputation credits, but as you saw from our tax pay position on the prior slide, not enough to fully impute this dividend. So this distribution of 15 cents per share will be imputed to 7 cents per share. In addition to the $189 million of ordinary dividends distributed during FY16, we also completed the $100 million share buyback program during the last half. We acquired around 20.7 million shares at an average cost of $4.83 per share. Since completing the buyback, we've been applying more cash to reducing debt, and during FY16 reduced the face value of debt by $71 million. We're frequently asked about our distribution policy, our credit rating targets, and how we think about growth. So we've prepared a slide that we hope puts it all together. As I mentioned, free cash flow is a key metric for us. It represents how effectively we are managing the business given the current asset base. For the balance sheet, and given the nature of our operational and financial risks, we want to maintain an investment-grade credit rating. To do this, we target a net debt to EBITDA ratio within the 2.6 to 3 range under S&P's calculations. And clearly, the ordinary dividend is a priority for us, and we have maintained it at a level above 100% of underlying profit for the last 2 years. Beyond that, we have some choices, and we are always looking for new ways in which we can apply our capabilities in order to grow the business. Naturally, we look for returns commensurate with the risks involved. Since Te Mihi, most of the growth investments have been relatively small scale but highly productive. And to the extent we can't find any growth investments that meet our criteria, then we will look to distribute cash to shareholders in the most tax-efficient manner possible, as we have done in the last couple of years, either as special dividends or as buybacks. And with that, I'll pass you back to Dennis.
Okay, so in terms of summarising, in this competitive market, we're increasingly turning our operational performance into value. Clearly, major improvements in both production and retail in the last year, but we don't operate in a vacuum, and Graham took you through the reduction in margins in the retail business, and I suspect that's a slide that would be able to be produced by our competitors as well. Having said that, the industry structure does support continued strong cash flow. The slow demand growth is unlikely to require significant capital being put into generation in the near term. Clearly, TY remains as a risk, but is increasingly manageable. Our growing capability in retail, with what I would say is the best-in-class modern systems, may provide some opportunities for us to expand either our products or the number of customers we serve through organic acquisition or through consolidation. We believe in the longer term there's an opportunity to deliver value for shareholders through transitioning the technologies we might offer our customers, but we don't see that as material in the very near term. The one thing that we have got going in our favour relative to our competitors is probably the industry best governance structure, a very open share register, liquidity in our shares, and therefore if opportunity does emerge over the next wee while, we are probably most able to act. But with that, I'll go back to the agenda chart, which is also the summary chart, and move on to questions, which I think Jenny may be first one.
Actually, I've got two. The first one's one that I asked last time, I'm sure. Can you explain retail netback to me? That the explanation obviously didn't stick.
So retail netback is the... think about what we receive from a customer minus the elements we don't control, such as transmission, distribution and market costs, and then take off our cost to serve, so the operational cost of running the business, and then what's left over is the netback.
So it's actually the profit you make from your retail operations?
No, it's the net revenue, which then goes to procure electricity or gas or whatever it is on behalf of those customers. If you go to the slide that Graham took us through on retail margins, then we identify the profit as being somewhere in the order of 5% on EBITDA, because that netback has to pay for the power.
Slide 23.
And the other question was about slide 10. It says number of customers, but up the side, but there's no indication of what the numbers are.
Yep, that's purposeful. It's an illustrative spread of the types of customers by CLV, but we're not going to commercially disclose those numbers.
I mean, surely you just take that graph and divide it through your number of customers and you come up with the answer, wouldn't you? Or have you deliberately distorted the scale?
I mean, we're giving a...
This seems a bit silly to me.
Well, it depends what you're going to do with the data. What we're showing is a trend to a higher CLV customer. The detail moves on a monthly, annual basis. Yes, you could add up all of those bars if you wanted and work out how many customers are in each of those.
Well, I'm not going to, but an analyst probably can.
Yeah, and they probably will, but we also haven't defined negative and positive numerically.
Well, at least the middle of that's zero.
We haven't defined that either. So it's a chart which illustrates a trend of improving performance in the business. It's not meant to be an analytical construct. That's proven in our operational stats every month by the netback we receive.
Can I ask a question, Dennis? We're about a month and a half into the current financial year and probably about almost 1/3 of the way through the current half year. So what forecasts have you got, Vinny, about how things are looking in the present and immediate future?
So we release operational statistics monthly. We'll probably get July's out tomorrow morning, and that will give you an indication as to how we're going. I mean, July was, relative to history, warm again, so volume was a little bit down. Reasonably consistent hydro inflows, good cost performance. So, I'm sure those op stats will show July this year being better than July last year, but 1 month doesn't make a forecast. But that's what we do. We release operational stats every month.
But if you had relatively flat underlying earnings in this one you've just given now, is that a flat underlying situation likely to continue?
Well, we give an outlook that our costs will continue to reduce, although we do have a margin reduction from the TY contract and carbon. The price changes we've made have been positive, but given the intensity of the retail market, we don't give long-term guidance of that nature. What we do is every month give the detail, which allows you to work out how we're going, and July was okay.
Okay, one other question, can I ask, one of the reasons for your bottom line loss is the big write-down from Otahu, which must have been really expensive to shut down. Have those costs been paid, or is there going to be any more costs to be paid in that process from the current financial year?
Well, I mean, there's two things going on there. There's the non-cash write-down of the asset. From a cash perspective, the write-down and closure was positive because we sold the land and we sold some of the equipment in the plant. So all of that is captured in the numbers. We transferred ownership to the new owner, I'm going to say in January. We have nothing to do with the plant anymore, other than some potential upside from selling kit throughout the balance of this calendar year. So it's all captured in the numbers.
Well, if it was positive, why has it produced such a negative result?
That's an accounting question, so Graham can answer that.
Two issues. One is cash, so it's positive for cash. So economically, it was positive to close it, but because it was sitting on our books for a large, multi-million-dollar number, but once you've closed the plant, you can't keep it on your books. So that write-down has to come through the books, and it comes through the P&L outside underlying in the current year. So it's a non-cash write-down of the asset.
Okay. So it doesn't signify any significant hardship in any way. It's really a numbers game to make sure that the accounts are all straightforward.
Yeah, I mean, I always talk about zones of reality, and cash is the closest zone of reality. Accounting's the next closest, and tax might be the furthest away.
Tax is real.
But the reality is, since we closed Otahu, we've only run our other CCGT, our large gas plant, for 43 days. So clearly it was a spare, redundant asset, which was getting no economic value. So the best thing to do was retire it. And it has two impacts. It hits the balance sheet in a non-cash way, and it hits cash flow in a positive way because we sold the land and some bits of kit.
And we stopped spending money on gas transmission, operational costs and so on.
Well, sorry, that leads on to another question, because if your other plant, which I think is your big plant at Stratford, yeah?
Yep.
You're talking about, if that only operated for 43 days, what's its long-term outlook?
Well, its long-term outlook is one where we continue to manage the flexibility of that plant such that if the market doesn't need it, we could also close that plant. Right now, with the TY contract in place, and, for example, it's running today, we do see some economic return on running that plant. But it's not hugely profitable. So we maintain flexibility on that asset.
And if TY were to shut down, maybe that Stratford plant might be
quite
a consequential casualty.
Yes, quite probably.
Sorry to go on, but
TCC.
Yeah.
Yes, right.
about the TY point, there's something here where you mentioned something about, I've looked for the slide, I can't find it, but you say something about if TY were to shut down, there might be a need for a second submarine cable. Do you say that here somewhere? I'm sure you do.
Yeah, if you think about what would happen if TY closes, the consumption of 5,000 gigawatt hours from the smelter, which is in the order of 13% of average demand in New Zealand, that production would still occur because it's hydro, effectively zero cost production. And that production would be most needed north. So the focus of the industry would be on getting that hydro production to the north, where most of the demand is and most of the demand growth is. And we think an efficient way to do that is by changing the way some of the market calculations work, so you can flow more on the HVDC, and possibly adding a cable. But we don't make that decision. It has to satisfy a regulatory test for Transpower to make the investment. But the more we look at it, the more we see a pretty rapid rebalance where plants like TCC close and hydro generation flows north.
The amount that TY takes is 500 and something. So are you basically saying 200 and something of energy couldn't get from the South Island to the North Island at the moment?
It's probably not that simple. The HVDC runs on average at about 700 megawatts in a mean hydrology sequence. When it's wet, it might run at 850 megawatts. And when it's dry, occasionally it flows the other way and power goes from north to south. So it really is a question of what the hydrology sequence is. But if you...
Is there going to be some generation in the South Island that can't get north?
If the grid is not upgraded, yes.
Yeah.
But that's what I'm saying. The possibility and the cost of the upgrade is looking much more manageable from our perspective, because we don't think it requires a new pole, which is obviously the expensive bit. And some of it we believe some of the flow we believe can be added with no capital cost. It's just how do you think about the reserves market, which is that market which sits beside the normal market to manage risk. So the HVDC is very flexible, and it's not fully utilised to its physical capacity today.
I was just keen to get a bit more sort of insight into that gas, stored gas write-down, just sort of what some of the levers, like you've mentioned carbon is part of that, and carbon pricing. And also sort of elsewhere you've mentioned that you don't think carbon's really being priced into the ASX futures at the moment. So I was just wondering if I could get some comments on that.
Well, gas is pretty simple. We have an obligation to value any inventory, be it a gigajoule of gas or a washing machine if you were Noel Lehman, at what the realisable value would be. And given the lower oil price and how much Methanex, the country's largest gas producer, consumer, is paying for gas, and what we see in the gas contract market, we believe the cost of gas should be reducing. We don't believe we can recover what we were previously holding that gas in storage for, so we've brought it down to what we think is a realistic market price, which has a whole heap of reference points. Carbon is not a big feature in that decision.
It's part of it, but it's a small part.
It's quite small. The question I have around carbon is, with a market that's now, approaching 80-odd% renewable, clearly the majority of the time the price is set by carbon-free production. So the effect of a carbon price is quite muted. It's just a cost.
So, Dennis, just to get back to the TCC, would it be fair, am I understanding this correctly, that even if TY Point didn't shut down, if it's just running for 43 days now with TY Point operating, that you're watching it carefully? You're not making any predictions, but it's something you've got to watch.
Yeah, you got to watch. Yeah. But it'd be pretty shitty if the lights went out for 43 days. So,
and in a world where there's a lot of water and it's been quite warm, so it's not going to run a lot when the weather's relatively warm and there's a lot of water around.
I was going to say what we are in is probably a 2-decade shift from old large plant, although still eminently maintainable and of good quality, to a more renewable market where flexible fast start plant is better suited. So if you look at our peakers, they come on maybe for an hour or two in the morning and an hour or two in the evening. They're very suited to the demand profile. And plants like Otahu, TCC, and to a lesser extent the Huntly units are just not that flexible. So it really is just a feature of moving to a more renewable market. And, you know, you pick the optimal point to retire plant and build new plant.
Okay, can I ask one more question? You paid out 120% of cash flow
Of underlying profit.
of underlying profit last year. And did you say something, Graham, that indicated there'd been a slight consequential cost to your books this year, that there was a slight, was it maybe paid out a bit more than you perhaps should have, or?
No, so we have a distribution policy that says we will pay out 100% of underlying profit. And for the last 2 years, we've paid out above that because the profit's gone below where it had been. But we want to maintain the dividend level so that our shareholders know that they can rely on receiving 26 cents.
But paying out 120% didn't cause you any problems in your finances for this year?
No.
I mean, our underlying profit per share is 21.7 cents, and we paid out 26. But our free cash flow per share was 55 cents.
So we paid out 47% of free cash flow as the ordinary dividend.
Yeah.
There's another 100 million that went out through a buyback as well. So shareholders got 47% of free cash flow plus $100 million of buyback.
And then the bank's got
70 million went to debt reduction.
Can't find the slide immediately, but you wrote a chunk off your gas. What's the value of the remaining gas?
$90 million.
Just on the retail side of things, you talk about, obviously it's very competitive out there, and you talk about, likely next step being more consolidation. Just wondering, I believe that before Trustpower was splitting up its business, it looked at sort of various options, and wondering if you guys ever looked at Trustpower's retail business at all, or if you're looking at any other retail businesses out there, to perhaps take part in that consolidation.
Yeah, I mean, just to be clear, I didn't say it was likely. What I said was that in a market where margins are reducing and there's probably a surfeit of competitors, then consolidating for efficiency is probably a good thing. We believe, given our systems investment and our increasingly strong performance in retail, we would be a consolidator rather than a consolidatee. And we don't talk about any specific ideas we might have about that. If, and I stress, if something happens, you'll know when it happens.
Just going back to that gas write-off. So you wrote off a third of the value of your gas that's stored.
Yes.
Can you explain why?
Because the future value of gas, as we see it from electricity prices, oil prices and gas contracts, is lower than the value we had it stored at.
That's a pretty hefty whack, isn't it?
It's just a function of where gas prices were 4 years ago, 5 years ago when we bought that gas. It sat on our balance sheet at that historic cost, and the market has since moved.
So you don't think you get any more value than 2/3 of what you pay?
That's right.
Yeah.
It sounds as though no one's really going to want to drill a new gas well or build a new power plant. If your energy costs are only $4 a megawatt hour and the gas is so low, we must be in a comfortable position for quite a long time.
Well, I mean, our power it came down by $4 a megawatt hour. It's still $30 a megawatt hour. I mean, we've said that for the foreseeable future, large centralised generation capacity is not required. Gas production in New Zealand is a byproduct of oil production, and the oil price is much more material to how a gas and oil producer will think about production. For many years, reserves coverage ratio, which is how many years have you got left of current production levels, is sat at about 12 years. It's still sitting at about 12 years. But the thing to note is that half of the gas in the country is used by Methanex. So if Methanex weren't there, then that 12 years becomes 24 years. So we feel pretty comfortable that there's gas around. It's worth less than it used to be. And you know, our interest is actually buying it for as low as we possibly can. We're not a gas producer. So yeah, I think part of your thesis is correct. You know, there's not a lot of capital required in this market in the medium term.
One last question. You've got some more work coming up at TCC and Te Mihi. I was just wondering if there's any sort of further details around that.
Well, TCC is its refurbishment that we announced last August. Combined cycle plants, you need to refurbish the engine every 25,000 hours. It's run 21,000 hours and it's close to needing refurbished. We may or may not do it in the timing that we've talked about. Given it's been reasonably wet and it's not run very much, we might not refurbish it in February, March next year as we're planning. To me, he's just on its 2 years inspection. So when you build a new plant, you're certifying authorities, whether it's for pressure vessels or any of the other operation of the plant. They inspect them after a year, after 2 years, and then quite probably we won't need to do a major inspection for 5 years at Te Mihi. But it's just in the normal maintenance cycle. We expect geothermal production to stay the same year on year, even with the outage, because we've got 5 producing stations in geothermal and we can move the fuel around a little bit. 5? Yeah.
I'll just have one last question. So the other thing that came up was you're going to have some new products come out in, well, this month, I guess. Can you say anything more about those products?
Well, they're already out, and what they are is really a pick and mix based on how many properties, whether it's your business, your home, or for some people, their second home, how many products, whether you want fixed or variable pricing, and how you want to pay, whether it's online, direct debit, and the big shift in the product construct is that all of these are now a pick and mix, whereas it used to be a very simple construct. We used to have online on time, 22% discount, you pay online, and that was it. So the main shift is to a much more flexible set, which gives the customer choice if they want it, certainty, and control how they pay and how they deal with us.
So sort of following on from that batch offer that you had over summer, and that seemed very successful. Yeah,
not dissimilar to that.
Yeah.
Think about when Air New Zealand went from their very complex set of pricing arrangements to seat plus bag, seat plus work deluxe. It's that sort of similar customer-centric design.
Yep. Cool.
I think if we're done in the room, we'll check if there's any questions on the phone.
Ladies and gentlemen on the phone, if you wish to ask a question, you'll need to press star 1 on your telephone. That won't be your name to be announced.
Thank you, Dennis.
See you then.
Yes.
There are no questions on the phone at this time.
Okay, well, we'll take one last chance in the room, but if not, thank you for your attendance this morning and the good questions, and I think I'm talking to a couple of you over the next hour or two. Thank you.
Thanks very much.